Imagine locking down a 30-year mortgage on a physical house using your Bitcoin.
Right, without ever actually selling a single coin.
Exactly. And never paying a single dime in capital gains tax. Now imagine doing that on the exact same day that missiles are literally striking United States military bases, global shipping lanes are shutting down, and, these multi-billion-dollar corporate mining conglomerates are just dumping their reserves onto the open market.
It sounds like fiction, but, well, here we are.
Here we are. Welcome to March 26, 2026. The mission for this deep dive is to decode what is clearly a structural phase transition unfolding in the global financial ecosystem right now.
Yeah, a massive one.
Because we are watching the market absorb this historic collision. You've got massive corporate sell-offs, severe geopolitical warfare, a heavy derivatives expiration. Yet the asset sitting at the absolute center of the storm, Bitcoin, is holding remarkably steady. It's just hovering near the $69,000 threshold.
Okay, let's unpack this. Normally, when you mix a massive supply shock with global warfare and high interest rates, risk assets shatter like glass.
Oh, absolutely. They usually just fall apart.
Right, but what you are looking at today is a market where the glass is actually reinforcing itself under the pressure.
It's a profound structural shift, honestly. And you frame the tension perfectly there. What we're witnessing right now isn't just some temporary market anomaly. We are witnessing the definitive domestication and institutionalization of cryptographic collateral.
Domesticating the collateral. I like that.
Yeah, because the market is actively, aggressively repricing the difference between a speculative asset and what is now basically a foundational layer of global macroeconomic plumbing. But to really understand the sheer strength of this current market resilience, you first need to understand the massive weight that is actively pulling down on it right now.
The gravity of the situation, yeah.
Exactly. Over the last 3 weeks, so between March 4th and March 25th, MRA Holdings, which is obviously one of the largest mining entities out there, they executed this massive supply distribution.
The brutal one.
Brutal is the word. They systematically offloaded exactly 15,133 Bitcoin onto the market. I mean, we are talking about approximately $1.1 billion in pure fiat liquidity extracted right out of the order books.
And we really have to look at exactly what they did with that $1.1 billion.
Right, because they didn't just pocket it.
No, because it reveals the thermodynamic realities of the post-halving network. MRA didn't sell this Bitcoin to secure executive bonuses or, expand into new speculative ventures. They sold to aggressively deleverage their balance sheet.
So they were paying off debt.
Exactly. They took that freshly generated fiat liquidity and used it to repurchase their 2030 and 2031 convertible notes.
And they bought those notes back at, what was it, an approximate 9% discount to par value.
Yeah, 9% discount. So by executing that repurchase at a discount, they saved $88.1 million in immediate cash. And they successfully dropped their total debt burden from $3.3 billion down to $2.3 billion.
Wow, so a full billion off the books.
Yep. And in doing so, they neutralized a massive equity dilution threat that was just hanging over their shareholders.
But the timing of this corporate distribution, it collided with an absolute anvil in the options market.
Oh, the derivative expiration.
Yeah. Right now, there is a $14.16 billion options expiration looming on the derivative exchange for tomorrow, March 27th. And the quantitative models show a max pain threshold sitting at $75,000.
Right. So institutional market makers are actively delta hedging.
Hold on. Let's translate that delta hedging stuff for a second, because that can sound like a foreign language to some folks.
Sure. Go for it.
Basically, these market makers sold a bunch of options contracts, and to ensure they remain financially neutral no matter which way the market moves, they have to constantly buy and sell the underlying asset, Bitcoin.
Right, they have to balance the scales.
Because that max pain price is $75,000, which is the price where the maximum number of options expire worthless, meaning the market makers keep the most premium. They are dynamically adjusting their books in a way that effectively puts a temporary lid on the price.
Which heavily suppresses the SPAT price to manage their gamma risk, yeah.
Exactly. It recently forced the market into a localized intraday trough of $69,164. But I want to push back on the mining side of this equation for a second.
Okay, what's the pushback?
If Bitcoin is the ultimate apex asset, why is one of its largest industrial producers dumping $1 billion of it? I mean, it feels a bit like a farmer eating their seed corn just to pay the mortgage.
That is the exact paradox a lot of quantitative analysts are grappling with today. And Well, the answer comes down to the brutal mathematics of the post-halving environment.
Because the rewards got cut.
Right. You have to remember how this system operates at the physical layer. With the block subsidies structurally slashed in half, the entities physically responsible for securing the cryptographic ledger are no longer operating in an environment of excess margin.
They don't have that cushion anymore.
Exactly. They are tightly tethered to the harsh realities of traditional fiat credit markets.
Wait, so you're saying because the block rewards were cut in half,
Right.
these giant mining companies are suddenly struggling to pay their everyday operational bills?
Yes. Their revenues were cut in half overnight, but their operational costs didn't drop at all. If anything, they went up.
Right, inflation.
Yeah, they were facing rising energy procurement costs and escalating semiconductor expenditures. So to survive the compounding costs of pure industrial operation, heavily indebted mining conglomerates are being forced to transition from being absolute accumulators into systematic distributors.
They just have to sell to survive.
They simply have to sell, yeah.
Which brings us to the billion-dollar question, literally. If industrial miners are forced to dump over $1 billion onto the secondary market, who on earth is absorbing all that supply to prevent a total pricing collapse?
That is the key question.
Because historically, a single corporate entity injecting that much exogenous supply would just crater the spot price.
Yep.
But it didn't. And the answer lies in a paradigm-shifting move by the United States government apparatus.
The Fannie Mae announcement.
Yes. Fannie Mae, the massive government-sponsored enterprise that provides the liquidity backbone for the U.S. housing market, has just formally announced it will accept Bitcoin and USDC as formalized collateral for real estate acquisitions.
And we really need to pause and recognize the scale of this.
It's massive.
It is being executed via a structured partnership between Better Home and Finance and Coinbase Crime. It allows prospective American homebuyers to pledge their existing digital wealth to secure a standard 30-year conforming mortgage.
So you don't have to sell.
Right. You no longer have to liquidate your digital assets to fund a fiat cash down payment.
Here's where it gets really interesting. Think about the staggering tax implications of this for you, the listener. You're telling me you can lock down a physical house, an actual piece of real estate, with your Bitcoin without ever executing a spot sale. No massive capital gains tax hit.
What's fascinating here is that the tax efficiency is just the localized benefit for the individual borrower.
Okay, what's the bigger picture then?
The macroeconomic implications are what permanently alter the structure of the asset. By allowing American digital asset holders to weaponize their digital wealth into synthetic purchasing power, the state is effectively engineering a massive, irreversible thermodynamic sink.
Okay, let me stop you right there. A thermodynamic sink. That sounds like something out of a physics textbook. What does that actually look like in practice for the market?
Fair enough. It is a bit technical. Think of it like taking thousands of cars off a busy highway and putting them into a 30-year parking garage.
Oh, okay. So the traffic just clears up.
Suddenly, the traffic jams, or in this case, the market sell-offs, just disappear. When you pledge your collateral for one of these Fannie Mae-backed mortgages, your Bitcoin is transferred into a highly secure institutional custody vault for the duration of the 30-year loan.
But you still own it.
You retain beneficial ownership, meaning you capture all the future price appreciation, but those specific coins are completely removed from the liquid circulating supply.
So the active supply is mathematically shrinking. But wait, what happens if the price of Bitcoin crashes? Do you lose your house?
That is the genius of the underwriting architecture here. To compensate for the inherent volatility of the collateral, these specific mortgages carry a structured interest rate premium.
Like a higher rate?
Yeah, about 0.50 to 1.50 percentage points above a standard loan. But crucially, the structure prevents devastating margin calls during transient price drawdowns.
Oh, wow. So if it drops 20% in a day...
You don't lose your physical house just because the spot market dropped 20% on a random Tuesday. The terms protect you.
That is wild.
And by locking up billions of dollars in collateral for 3 decades, Fannie Mae is contracting the circulating supply. They are creating the exact institutional demand required to perfectly absorb the industrial dumping we just saw from MR Holdings.
It perfectly balances out. And, the reason the U.S. government might be rushing to integrate this digital asset into everyday real estate is because the traditional oil-backed fiat system it usually relies on is currently on fire. Literally.
Literally on fire, yes.
This unprecedented integration into traditional real estate we just discussed is happening at the exact moment. The legacy geopolitical systems are showing catastrophic fractures. The diplomatic containment architecture in the Middle East has completely failed.
They're totally broken down.
The architect of the Strait of Hormuz blockade, IRGC Navy Commander Rear Admiral Alireza Tangsiri, was just assassinated in a highly sophisticated airstrike in the southern Iranian port city of Bandar Abbas.
And we have to recognize Tangsiri's role here. He wasn't just a figurehead. He was the strategic architect responsible for choking off a maritime corridor that processes roughly 1/5 of the world's daily global crude oil consumption.
1/5. That is insane.
Right. The elimination of that command structure completely incinerated any remaining rules of engagement in the region. In direct retaliation, the Iranian military apparatus launched Wave 82 of Operation True Promise 4.
And the physical destruction of Wave 82 is fundamentally altering global risk models right now. We are talking about a devastating swarm of loitering suicide drones, followed immediately by advanced ballistic missiles.
Specifically the Khaibar-Shikan platform.
Yes, the Khaibar-Shikan. And they didn't just target Israeli urban centers like Tel Aviv and Haifa. They expanded their target matrix to actively engage sovereign United States military bases in the Gulf.
Unprecedented escalation.
Totally. Heavy munitions struck the Al Dhafra air base in the UAE and the Ali Al Salem and Arif Jan bases in Kuwait.
The strategic audacity to strike forward deployed Allied infrastructure proves that deterrence is currently non-existent.
It's just gone.
It is. This conflict has metastasized into a direct, multi-front regional war. And for macroeconomic fiduciaries, this dictates a mandatory realignment of inflation expectations.
Because of the oil.
Exactly. The blockade of the Strait of Hormuz isn't ending anytime soon. Decentralized naval units will just continue these swarm attacks. That guarantees a chaotic disruption of global energy transit, which generates immense upstream inflationary pressures across the entire global industrial supply chain.
Which bleeds directly into the domestic macroeconomic data.
Right on cue.
Yeah. While missiles are flying in the Gulf, the U.S. Department of Labor just published its jobless claims report. Initial unemployment filings came in highly resilient at exactly 210,000.
The domestic labor market is running incredibly hot.
So hot. So you have Federal Reserve officials, Governors Lisa Cook, Michael Barr, and Vice Chair Philip Jefferson all stepping up to the microphone, maintaining a highly hawkish, restrictive posture.
They can't cut rates.
They are signaling they will not cut interest rates because they have to fight the inevitable energy inflation stemming from that Hormuz blockade. But wait a second.
Yeah.
Global war breaking out, energy logistics failing, and a Fed that refuses to cut interest rates because the labor market is hot. Historically, that exact formula triggers a massive flight to the U.S. dollar and a dump of non-yielding assets. Why isn't institutional capital fleeing crypto right now?
This raises an important question, and it is the exact question every quantitative risk manager is actively modeling today. Why is Bitcoin decoupling from traditional interest rate sensitivity?
Right, it doesn't make sense historically.
The answer is that the legacy sovereign risk models are fundamentally broken. The traditional safe haven instruments are failing to provide safety.
Because the fiat system itself is tethered to the vulnerability.
Exactly. I mean, central banks possess incredible monetary power, but they cannot print a barrel of oil. And they cannot deploy military escorts to secure every single commercial vessel in a burning maritime choke point. Fiat currencies are structurally tied to these vulnerable physical logistics.
The shipping lanes.
Right. So the yield on a U.S. 10-year Treasury note might look elevated right now, but institutional capital is recognizing that the long-term debasement of the dollar is a mathematical certainty. It's required to service the compounding sovereign debt burden.
They have to inflate it away.
Capital is actively reallocating to mathematically verifiable, censorship-resistant collateral because it is the only asset capable of surviving a localized geopolitical collapse without friction. It settles billions of dollars instantaneously without relying on shipping lanes or the explicit permission of warring sovereign states.
And as capital flees the legacy system, we are seeing it become highly selective about exactly where it lands within the digital space.
Very selective, yeah.
It is heavily favoring ossified, trusted networks over, secondary experiments, and the regulatory state is moving remarkably fast to accommodate this shift.
It really is.
We just saw the United States spot ETF complex register a $7.8 million net positive inflow, which halted the recent bleeding. But the bigger structural move happened in the Federal Register?
Oh, the joint interpretive guidance.
Yes,
Yeah.
issued by the SEC and the CFTC. By formally publishing this in the Federal Register, they basically bypassed the traditional lengthy notice and comment period, granting the guidance immediate operational authority.
Which is a huge deal.
They officially classified 16 major crypto assets, explicitly including Bitcoin, Ethereum, and Solana, as digital commodities. This formally strips them of their presumed security status and shields the underlying protocols from SEC enforcement actions.
Finally giving some clarity.
And while that ink is drying, the Senate Banking Committee is simultaneously scheduled to hold a markup session for the Digital Asset Market Clarity Act.
We are witnessing an institutional embrace at the highest levels of the state. It's undeniable at this point.
But we have to contrast this regulatory integration of the base layer with the absolute chaos currently happening in decentralized finance, or DeFi.
It's a completely different story over there.
Yeah. The peripheral DeFi ecosystem is struggling to contain the fallout from a severe infrastructural failure. Resolve Labs, which is the architectural entity responsible for the USR stablecoin, suffered a catastrophic vulnerability.
A massive exploit.
An unknown adversarial entity was able to illegally mint an astonishing 80 million unbacked USR tokens.
Just out of thin air.
Out of thin air. And the way the developers mitigated this was, frankly, stunning. The protocol developers deployed emergency smart contract upgrades to manually quarantine the network.
Manually.
Yes. They effectively neutralized 57% of the illicitly generated supply. They burned 9 million USR tokens directly and cryptographically locked another 36 million inside a blacklisted address by forcing a conversion into a wrapped format known as West USR.
They essentially built a digital quarantine zone on the fly just to trap the stolen funds.
So what does this all mean? I mean, if developers can just hit a massive undo button, freeze addresses, and incinerate millions of tokens, that's not decentralized finance.
Not at all.
That's just a traditional bank wearing a digital mask.
That's a great way to put it. And if we connect this to the bigger picture, the Resolve Labs intervention provides the ultimate philosophical proof for why institutional fiduciaries are overwhelmingly choosing Bitcoin over secondary networks.
Because it's actually decentralized.
Right. For a macroeconomic allocator, watching a core development team unilaterally upgrade smart contracts and freeze user assets exposes a fundamental contradiction.
It's a huge red flag.
It mathematically proves that these secondary network tokens possess the exact same centralized counterparty risks as the traditional fiat banking architecture you are supposedly trying to escape.
You are literally just trading one set of administrative keys for another set of administrative keys.
Precisely. And in an environment defined by geopolitical kinetic failure and fiat debasement, capital demands absolute immutability. Bitcoin's completely ossified base layer and its absolute lack of administrative keys makes it the singular, trustless global reserve.
It can't be tampered with.
No. The DeFi exploit perfectly highlights why institutional capital will tolerate the slower, methodical nature of the Bitcoin protocol over the highly experimental, mutable nature of secondary lending markets. When the world is incredibly unstable, you don't want your money to be experimental.
No.
You want it to be predictable.
Okay, let's synthesize exactly what we have unpacked today, because the sheer velocity of this structural transition is staggering.
It's a lot to take in.
It is. Over the last 24 hours, the market digested the MARA Holdings capitulation, a $1.1 billion supply injection. It digested the gravitational pull of a $14 billion derivatives anchor on Deribit.
Right.
It processed the physical reality of Wave 82 ballistic strikes raining down on sovereign United States military bases in the Middle East, and it absorbed restrictive macroeconomic labor data guaranteeing elevated borrowing costs from the Fed.
Any one of those would normally crash a market.
Exactly. Yet, the ecosystem held its ground. It held strong because of the stabilization of traditional ETF inflows, the immediate operational authority of the SEC and CFTC commodity classifications, and, of course, the historic integration of cryptographic collateral into the Fannie Mae mortgage architecture.
And you must recognize why this synthesis matters directly to you, the listener.
Yeah, why should they care?
If you are listening to this, you are not just watching transient price action on a screen. You are witnessing the permanent financialization of digital scarcity. Deep storage Bitcoin is no longer functioning as some speculative technology proxy. It is actively upgrading into the foundational plumbing of the global economy.
The plumbing, I love that.
As traditional authorities exhaust their diplomatic interventions and heavily indebted industrial miners exhaust their treasury reserves, the institutional requirement to hold verifiable non-sovereign collateral is transitioning from a theoretical debate into an absolute mathematical certainty.
I want to leave you with a final thought to mull over.
Let's hear it.
If the legacy system is fracturing to the point that massive maritime choke points like the Strait of Hormuz can be completely shut down, and sovereign United States military bases can be attacked with heavy ballistic munitions without any functional deterrence, how long until a sovereign nation decides that holding decentralized, non-confiscatable collateral isn't just a corporate investment strategy, but an absolute matter of national security for settling international trade?
Wow, that is the question.
Remember the glass we talked about at the beginning of the show? Normally, pressure shatters it. But when you apply the exact right amount of pressure, heat, and kinetic force to the right materials, they don't break. They forge into something entirely unbreakable.